Hi, I'm Cormac Kinney. I'm the founder of Diamond Standard. You probably realized that we developed the world's first and only diamond commodities. These, for the first time, make diamonds accessible to investors because these bars, and we also make coins, are all equivalent. These are assembled under regulatory supervision, and our production is audited by Deloitte. That means that every bar is the same, so that for the first time, you can invest in diamonds and buy and sell those commodities on the market. We launched this commodity in 2002, and immediately it took off. We have thousands of hedge funds, family offices, and individual investors that own Diamond Standard commodities. They use diamonds as a diversification, as a hard asset that won't go bankrupt like a stock or bond possibly can. But a lot of clients came to us and said they didn't want the nuisance of actually custodying a hard asset, managing the vaults, managing a custodial relationship, paying for custody. And a lot of clients wanted to invest through an IRA account, which cannot hold commodities. So for these investors, we created the Diamond Standard Fund about a year ago. The Diamond Standard Fund is very simple. It simply sells shares and buys and holds commodities. It's very efficient, so you don't have to deal with custody or deliveries, things like that. So it made diamond commodities into a titled security that any investor can hold, including individuals, IRA accounts, but also RIA firms. So the announcement we're making today is that Diamond Standard Fund is being listed for trading, meaning that if you're an investor in Diamond Standard Fund, after the SEC mandated lockup period, depending on where you're located, you can trade your shares, and that is on Oasis Pro, which is an SEC licensed ATS, or alternative trading system. So in this quick video, I want to talk about the fund, how it works, but also why we think now is really the right time to invest in diamonds as a new asset class. As a quick review, the Diamond Standard coins and bars are the world's only regulator-supervised diamond commodities ever. Every diamond bar or coin contains natural diamonds, and they're always in a group that's optimized to always add up to the same carat weight, color, and clarity. This means that every coin is equivalent. And so when you trade coins, you don't care which coin you get. They all have the same value. That market value is not up to us. It's like gold, it's traded on the market, and we look up the price on Bloomberg. As of a couple days ago, that price was $4,330 for a coin and $43,300 for a bar. These commodities are assembled under regulatory supervision. Every diamond is inspected by 2 gem labs, and they're always custodied by qualified custodians like Brinks. The audits are performed by Deloitte. These commodities have gotten a lot of media attention in the Wall Street Journal, CNBC, the Financial Times, and on Bloomberg. And our focus has been to provide these to institutional investors, but obviously they're suitable for any type of investor. The reason diamonds are very interesting is because they've been an inaccessible asset class for decades, whereas all the precious metals, gold, silver, platinum, and palladium, have all been held by investors for centuries. But more recently, all of these precious metals have been financialized, meaning that they've been available in products like ETFs in future. Because of this, they've all develop the same following, which is about 15% of the total supply of each of those metals are currently held by investors. But investors only own about 2% of diamonds. So we think diamonds have the potential to catch up with platinum, for example. And as investors buy 12 or 15% of the world's diamonds, we think that causes the prices to go up. The products that are going to enable that investor allocation are all the products that Diamond Standard has been working on. The spot commodities allow diamonds to be traded with a lot of efficiency. In fact, they're traded electronically. We've launched that spot market. It's based in Delaware. We've launched the first ever Diamond Standard Fund that we're talking about today. We're also launching something called Carats, which I'll explain in a second, but it's basically a digital version of our commodities that can be used for payments. We're in the process of developing exchange-traded funds. In fact, we filed with the SEC to list on the New York Stock Exchange. That's going to take some time, but in the meantime, the easiest vehicle is Diamond Standard Fund, that if we're approved, that will become the ETF. But the other financial products we have approval for include futures and options. We're developing a futures contract in partnership with MGEX that will list on the CME Globex exchange. Ultimately, someday in the future, diamonds will be added to the commodity indices like S&P, Bloomberg, and Goldman Sachs. Once that happens, every exchange that tracks commodities will automatically add diamonds. That'll be a huge rush of demand. I mentioned to you carats. Carats are a digital token that's actually issued by the Diamond Standard coins and bars, by the computer chip that's sealed inside with the diamonds. Those carats are like Bitcoin or Tether, except they're not a security and they're not a cryptocurrency because they're issued by a physical commodity and not by a sponsor and not by a computer. That means that carats are legally a commodity, which allows them to be sold through investment platforms like Revolut, Robinhood, and Wealthsimple, but also they can be used as a payment mechanism inside of platforms like X or Instagram, where if they used a cryptocurrency, they would need to get a money transmitter license. Because carats are a commodity, they don't need a money transmitter license. So they're really somewhere, right between gold and Bitcoin. And we think that carats have a lot of use cases in the world and that those use cases will create demand for diamonds. And we think that could drive the prices up. In fact, we found a number of applications for Diamond Standard commodities that we weren't expecting. We built them for investors to enable all of the financial products. We realized they're especially useful for electronic payments, where you don't want to trust the issuer, where only the commodity can issue the currency. But we've also learned that our commodities are extremely useful for Islamic finance, where they're not allowed to lend money and charge interest. Instead, they use what's called a commodity murabaha, where the bank lends a commodity, like Diamond Standard coins and bars, to the borrower that they sell in the market, and they use those proceeds. Then they owe the bank for a commodity purchase. They don't owe them for interest. Finally, we've been asked to publish a white paper, which you can find online, to explore how our commodities could be used to support a currency for the BRICS countries. The BRICS countries all happen to produce or process diamonds. So Diamond Standard has been around for 4 years. It's a very experienced team, a lot of experience in Wall Street. I've mentioned that we have the world's only regulatory license for a diamond commodity, and we're audited by Deloitte, and these commodities are deemed good for delivery for CFTC futures and options. But now I want to talk about this macro environment for diamond commodities, why we think now is a good time. Well, number one, diamonds are diminishing. There haven't been any diamond mines discovered for over 20 years. And in fact, all of the existing mines are expected to be depleted within 40 to 50 years. And that means that diamonds are running out. At the same time, the demand for diamonds has been consistently rising alongside the demand for luxury goods, which has grown at about 6% of compounded annual growth. That's driven by China and India. As more people join the middle class, they start buying luxury goods, including diamonds. So with diamonds, you have diminishing supply in the face of increasing demand, plus you have the demand from Diamond Standard for all of these different financial products, which is completely new demand. We think that that creates an environment where prices are likely to go up. A lot of people ask about synthetic diamonds. Of course, our commodities are only natural diamonds, and it is easy for a gem lab to tell the difference between the two. Your girlfriend can't tell, but the gem labs can tell very easily and instantly. What we've seen with lab-grown diamonds is that the prices have fallen dramatically. This is a few months old. The prices have fallen by over 80% in the last 4 years or so. Synthetic diamonds are becoming a lot like cubic zirconia. They're nice, they're great for fashion, but they don't hold their value. It's a lot like the original Picasso painting versus a lithograph. It's a bifurcated market. So I mentioned that diamonds were left behind compared to precious metals being financialized. The result of that is that all of those precious metals have gone up 4 to 6 times in price over just the last 20 years. In fact, gold has outperformed the S&P 500 over 20 years. People don't realize that. We believe that as diamonds become financialized, they will pick up off this flat line that they've had for the last 20 years, and that will cause diamonds to inflect the same way we saw gold and silver. You see here on these charts, the first gold ETF launched in 2002, and that preceded a significant run-up in price, in part driven by the demand by ETFs, where they drove up the price as they accumulated over $100 billion worth of gold. The same exact thing happened with silver in 2005, but also more recently, the first ETF for uranium launched up in Canada. That preceded a 2.5 times increase in uranium prices, in part driven by that, because the Sprott and Yellowcake uranium funds, they actually acquired almost $7 billion worth of uranium. In this chart, we're looking at a long-term zoomed in detail on diamond prices. And what you'll notice is that unlike gold and silver, they've stayed within a relatively tight range. They did briefly go up during the financial crisis, but right now diamonds are back at their floor, which is around $4,200. And this data, by the way, is available on Bloomberg, S&P, and Refinitiv. You look up the DIAM index. What we see, though, is in fourth quarter of 2023, diamonds hit a floor and they bounced off. That same floor has been consistent, and it's essentially the marginal cost of the mines to replace diamonds. They won't sell diamonds significantly below this price because they don't make money. The other aspects of diamonds that are interesting, so we think that this means that that floor is a little bit of downside protection, and that diamonds have a lot of upside potential similar to gold and silver. But as I was saying, the financial aspects of diamonds are interesting. They have extremely low correlation to any other assets, gold, silver, or stocks and bonds. This means that they're a valuable addition to any portfolio. And they also provide a good amount of insurance, because if you look at the several last crises, diamonds have dramatically outperformed stocks, which tend to be very, very sensitive to inflection point changes. So we think now is an interesting time to invest in diamonds, but we also think it's a great opportunity because the shares can now be traded on the Oasis market. If you'd like to learn more, please visit fund.diamondstandard.co. You can also request this investment guide about diamonds, which has a lot of the charts that we discussed, the supply and demand, has details on how we make these commodities if you're interested. And otherwise, please email hello@diamondstandard.co. I want to thank our partners at Oasis Pro and also Horizon Kinetics, which is our co-sponsor of the Diamond Standard Fund. Thank you.